And we are live as well. He had some technical issues, but I hope everything is solved now. Hey guys, hello to everyone else as well. Steady State welcomes you all, and thanks for joining us today. Let me see. So my name is Sylvia, aka Crypto Empress. I'm here today to help you get your questions answered and to validate the Fireside chat. Any questions you have, you're welcome to the stream chat, and I'll forward them to our speakers. We also invite you to take part in our meme contest, which ends in 8 days. And we also invite you to take part in Steady State's Ambassador Program. All the information you can find from our Telegram or Discord channel. Our today's speakers are Jonathan Libby, who is the CEO and founder of Steady State. Then Akash Mahendra, who is the head of operations and strategy at Steady State, and Brian McCabe, who is the CMO of Steady State. Also a reminder, we are not financial advisors and nothing we say should be taken as such. This is for entertainment purposes only. Today, we look at DeFi and parametric insurance. Is this the perfect marriage? First, let's take into discussion what type of insurances are there. I can name 3 big ones like life insurance, home insurance, health insurance. But what is their basic design? How are they built? Can you share to us?
Insurance. Well, first we got to understand what insurance is. When you think about protection, you're always making decisions that you think are best for you at any decision or any moment of time. And you're making decisions to mitigate risk of an event happening, but you can never 100% mitigate the risk of an event happening. So the goal of the insurance is if something unknown happens, that you have the means to both get yourself taken care of, as well as making sure that your finances aren't totally destroyed when that event happens. So life insurance is an example of, first of all, when you pass away, okay, or when someone dies, is are you gonna due to some kind of sudden event out of your control? If your family, you have loved ones, and you are a provider, or you want to make sure you're providing for them, you can't do that when you're dead. So life insurance is an agreement that if you die of natural causes to certain events, then you can have a means of way to take care of your family. And then there are multiple different breakdowns from there. I'm not sure if we can go into whole life versus set periods and all that. But so health insurance, functions in a very similar way, where you need protection for different kinds of events that could destroy, again, your not rather than hurt your family necessarily, it hurts your ability to. It's a very big financial burden, health. So it gives you something to lean on to take care of that burden. And then there's another one, which is very normal, which is property and casualty. Houses are very expensive, cars are very expensive. So when some kind of serious amount of damage happens to a business building or some kind of a personal building, it allows you to make sure you have the means to protect it if some kind of natural cause, or some dumb kid with a bat, hits a ball through your window or something. If that was insured, you're insured for that. It allows you to basically, due to unnatural causes or natural causes that are out of your control, get layers of protection. And that's kind of the point of insurance. And so those are kind of 3 things you're going to be looking at. A lot of those use this process called indemnification. How indemnification works is people go out and when an event happens, you can file a claim, and people go out and evaluate the event, how it happened, and try to prove whether or not the event was what it is. Indemnification is how a lot of insurance works, and because of that, how normal insurance works, it's a lot of people have serious issues with it. You could get in a car accident. Okay, someone could seriously hurt you for life. And when you're indemnification, you're valuing the payout or valuing agreement. The goal is not for these insurance companies is not to pay you out. So you could get in a serious car accident. Someone could rear end you and really give you, say, serious back problems. You can be spend 4 years of your life recovering from such an injury. And you could, because this indemnification is constantly being evaluated, the person at any point who hit you could say you were faking your medical injury, or they could say that you're extending it, or any of these kind of events, and the insurance company could use that as an excuse not to pay you, and it becomes very dangerous. And that's what a lot of insurance companies, how they're using right now. And this approach is actually what's being used currently in DeFi insurance, where people are trying to figure out who pays out what and whether or not someone deserves a payout. And that's kind of differentiates it from Parametric at a high level. But yeah, those are kind of the three main insurances, and they all use indemnification.
Yeah, and just adding to something what John said, DeFi, I'm sure we're going to discuss this soon as well, but everyone's after faster payouts and flexibility, and this is what parametric insurance offers. The issue is, in a lot of current protocols, for example, these payouts can take a very, very long time, and it doesn't really fit the entire ethos, entire mindset that the DeFi users have, that everything needs to be not exactly instant, but in a reasonable, needs to be done in a reasonably quick time. And it's all about faster payouts in the end. There's been a legitimate claim, legitimate hack, there's been some malicious actors, or there's been some reordering of the mempool. Just the claim needs to be paid out as soon as possible, as soon as everything is verified. And parametric insurance offers that possibility.
Yeah, thanks for the explainer, John. I think it was a nice intro to insurance. So when I think about the main thing here between parametric and traditionally, it mainly comes down to what you said is this indemnification costs. And I guess you could almost call this like an inefficiency in the current model, that it takes time, it takes effort, it takes surveyors, it takes people to figure out the exact issues around the case. And yeah, as I see more and more, when we're dealing with parametric, it seems very similar to yes, no events which can be easily detected as true or false. And the more I see into this is having this, as we have in DeFi, oracles which we trust that say this is what happened. This seems like as long as we can build out this kind of oracles and sources of data which we know are true, then there's a very good case for parametric being the dominant model in DeFi. I guess, where are we with, in your mind, getting to the point where we can trust the data? Because when I think about the example you gave earlier about home insurance, if a kid hits my window with a baseball and it breaks, it's very difficult to have an oracle of truth on who hit the ball. Is there a camera? Can we prove it? I can see all these inefficiencies which come in, which make this not a very good model for something. Likewise with a car, maybe Teslas could go parametric because you can have so many sensors on the car that if there is a collision, you can tell, okay, the damage was this. So potentially it could be covered under a user agreement or something like that. It sounds like it comes down to sources of data, sources of truth, the way you put it. And yeah, it's maybe tell me a bit more as a curious marketing person.
All right, thanks, guys. So we got the whole concept of this basic insurance now. Hope our listeners got the point as well. But now let's talk about what is the basic concept of parametric insurance. What are the examples of that?
So in the real world, parametric insurance is often a form of insurance used for people. So indemnification has a lot of problems. It always will. Because in the end, you have two actors that have two divergent needs. One wants to be paid and one doesn't want to pay out. And one is trying to keep getting paid, and then one's trying to keep finding reasons not to pay out. And so what Parametric, sometimes there are certain things that are so controversial that they can't be indemnified, and so one kind of like very normally put for parametric indemnification is like often used. I think a great example is for catastrophes, natural catastrophes. If a storm hits in this area and there are damage succeeded, and you want to pay out because you got insurance, say for like flood insurance, and indemnification, an insurance company go out there and look at the payout and be like, I'm not going to pay you out because you didn't do this on your hinges, or I'm not going to pay you out because you didn't do this or you didn't get that and that. And even if it's more than the expected requirements or whatever was needed necessarily from that country to do this. What parametric basically does is you have a predefined terms. If these criteria hit, if you have XYZ flood, the town takes XYZ value and damages, and you're a part of that town, and or the building you're in take XYZ amount of damages, then payouts trigger. So because payouts and the payouts is triggered against public, transparent information that can be evaluated by anyone, and the criteria is agreed upon pre to the event. And so that's the really big identification is you just agree, you agree to, I want insurance for a bug. Okay, well, that's indemnification, but I want insurance against a bug for these contracts and XYZ criteria is hit. Okay, and I need payouts on this amount of loss based on this amount of value. Parametric insurance actually goes and says you just agree to the predefined events and we start building out from there. And that's kind of like the big, that's kind of the big difference. And so I would say that's kind of like where indemnification is say I have health insurance, but then you get your health insurance and you're like, oh wait, I'm not covered for this, and this and this. Whereas parametric is I know I'm covered for this, and this, and I know we agree to what the predefined events are. And that's kind of a big key difference, I would say, to indemnification is parametric. And that's what allows the cash out of flexibility and immediate payout is you can eventually identify that. And you also see the flexibility where you get the money, you can choose to use it how you wish. So when you think about crypto and DeFi, a lot of the data we live and do is on chain or it's distributed on chain from off chain oracles. We have reliable data sources and data points we can be looking at on predefined events to really determine, as long as we correctly categorize and standardize what the events are that can create payouts. And secondly, because we have predefined events and oracles, it actually, in theory, as we understand it, becomes a much more efficient form of payout. Because this on-chain, this public data, these oracles, we don't have to rely on someone going and evaluating. We can create criteria. If this oracle produces this, if this event produces this, if this criteria produces this, then trigger payout. And not only, and those are the key differences, and this is why parametric is actually a better method, I would say, long-term in DeFi and crypto, as well as in any blockchain ecosystem, than indemnification. No one likes claims. No one likes having to file a claim and go through the payout because you have an actor constantly looking to not pay you out. With predefined terms, predefined payout methods, and using a smart contract to help determine that with different network distributors giving it information, it reduces the arbitration between two people and relies on technology to create a better, faster system for everyone.
Thank you, Jonathan. Do you guys want to add anything?
I'll just quickly add. So it sounds to me a bit like when we compare the two models, it seems like a lot of this indemnification work is done in advance if you consider parametric. So like when it comes to writing up a contract of insurance, which is parametric, it sounds like we have a lot more variables that go in there in the onset so that we eventually preempt every case which there is a payout. So is there a case to be made that there's a lot more brokering, a lot more like maybe clauses to write in when it comes to parametric on the initial issuing of insurance, but then it obviously speeds things up in the case where there is a claim or someone needs to actually make a payout. So the efficiencies are probably felt by the user and the pain sides are probably felt by the brokers making the contract, right, in the initial case.
Right, thank you. You already, Jonathan, went into a bit the why is parametric insurance great in DeFi, but maybe you guys want to add anything. Why is it good in DeFi to use parametric instead of regular methods?
So, you have something you want to say, Cash?
Yeah, no, I was just thinking. I mean, essentially, the main thing people in DeFi do really care about, as I mentioned earlier, was faster payouts, flexibility, and the possibility to try and provide coverage for things which may be difficult to model the losses for. Now, in DeFi, it's great because we have contracts that are designed in such ways that they pay off solely of based some certain parameters if they're met, ensuring that essentially every party involved knows when the payout mechanism is activated. Now, in this is good because everyone's aware of what's happening, what's required, and it's all kind of open, and nothing can be left to chance. Now, I know what's happened previously in the current insurance market in DeFi. A lot of these claims can be claims are processed. They're based on governance models, which is great, but when you allow sort of humans to decide things, they can be swayed by emotions, they can be swayed by bias, and they also can end up making mistakes. So it's one of those things where, and they also might just decide not to pay out. So there's less certainty. But the parametric insurance model that Steady State is obviously going to implement is going to use avoid all those issues. If there's legitimate claim being made, there's legitimate sort of hack, and people actually lost money and they were covered for it, well, they'll be guaranteed their funds. So that's going to be a big plus. And then, yeah, it's very exciting to be part of this this kind of change, because this not essentially a guarantee or certainty that makes sure that the people affected actually are properly insured and get their funds will start getting mom and dad retail investors in, because then they'll know that their funds are safe. We'll start getting institutions involved in DeFi because they also want some certainty for their investments, and they're beholden to their shareholders. So there's a lot of possibilities here. If we get this modeled right, if it works, and if it's built properly, and it's got the flexibility that people need, then there's a lot of possibilities of really expanding the market here.
Thank you, Akash. But why is Steady State working with a parametric model over traditional models, and what are its advantages and disadvantages?
So the parametric model made sense for a few reasons. Currently, the model we use in insurance right now in DeFi is indemnification. And indemnification, this model has really become incredibly controversial because these mutuals that go off and decide payouts are often very selective in how they pay out, which is fair. Just like a normal insurer, a group of people mutually come together, putting together money that create a payout would also be selective and very careful about the payout and look for a lot of reasons not to pay out. So the parametric, with the smart contract technology determining the events, we have something there. We have precedent. We can look at that and point to that. Rather than a group of people coming together, and use that as the beginning point if there's any form of arbitration, rather than having to deal with figuring out from the start. The other key thing I would say that about parametric versus normal insurance is insurance companies need very good insurance models for themselves, and protocols need very good models for themselves, for which they know like what they're trying to protect, because every protocol may use the same contracts, but they can be used differently. And so there's a real need for customizability, and that customizability that indemnification doesn't necessarily allow, because there are things they agree to cover and things they don't agree to cover, and they say, I'll generally cover here, so you think it's customizable, and then it goes through an arbitration. That's often not. We can create agreements prior, if this and payout, And that kind of customizability, I think, is very, very important in crypto and DeFi as we're navigating it. So it's selective in the point where, we have insurance that has predefined events, predefined payouts, predefined agreements. But not only is it predefined agreements, predefined payouts, it's also customizable in the sense where we agree to how the payouts and how the identification happens, to how it works out when it's agreed between two parties. And that customizability allows each protocol and user to each protocol to make sure they have a model put together that actually cover the needs of their community and the needs of their protocol. In my opinion, Parametric is a much, much more powerful model for that, and other reasons I've stated earlier. And it's going to be really impactful long-term in crypto and DeFi, and probably in normal insurance as well, as a new model people will be looking at.
Yeah, I think you said it pretty well there, John. There's like no, end to the number of efficiencies that's there, and anything that's like very data driven and you have like hard sources of data and truth, it seems like Parametric is a very good model to go with. But just got me thinking there about like traditional models too, and a case I suppose which might be just good to bring up is when we think about what happened COVID-19, and basically you had companies which had disaster insurance or business interruption insurance. And then I think what happened very quick was a lot of people said, okay, well, actually, this isn't something we can cover because I can't remember exact reasons, but essentially because worldwide pandemic isn't written into your policy, therefore you're not covered by default. Is this something that parametric insurance can solve, or potentially it's still one of these like outside cases where you would have to say, okay, I want to have pandemic insurance in my policy, which will pay out parametric, and we will have to calculate the risk.
What you agree is if there's a sickness or an illness that takes over an area, and what you could say for like say a disease insurance, the payout is based on your years past, month-to-month revenue generation is payout month-to-month for like, for each month a criteria hits during a disaster. So say lockdown, okay, say I am forced to not work due to disease or something, you can create a payout like that, or you have to include that. So you would say, again, something like the flu. Actually, there is insurance policies like this, actually, Brian, but already out there. But you make basically an agreement that like if an XYZ disease occurs, okay, any kind of disease that applies XYZ harm over a certain parameter agreement, then my payout is going to be basically predefined based on the amount of loss on a month-to-month based on my revenue from the year before. So say in the month of February, I historically make $40,000, but this year I only made $6,000 because of the agreement criteria for like a global payout, because it's just like, oh wow, I couldn't predict COVID-19, but I could predict, say, a health disaster, and then you create the agreements for criteria for a health disaster. You look at that, you submit your month revenue for $6,000, and you get you made $40,000 in the month of January of the year before, then you actually get $34,000 reimbursed, and it's just naturally flexible. You can submit, here's the money I made, here's money I made last month, and you just like the same month, and then you would just like, because I have like global disaster and health categorized fourth lockdown on XYZ countries and in my area or XYZ states in my area, you can actually really put that together like that, something like that. But ironically, there were people before this who had events for health disaster insurance like this. And it's kind of interesting how many more policies were distributed after COVID-19.
Yeah, they were probably all watching Utopia.
Yeah,
but no, I'm just joking. This it's a very interesting thing, and like I'm very interested when it comes to learning more about parametric insurance and how we're implementing it. And these kind of talks are great. Like I'm also curious as well. Like when it comes to parametric, when we're writing initial contracts, we can also have the option, right, to write in conditions that the person would not get paid out. So if I was to write a parametric policy for steady state, for example, I might write as part of this that John and Akash can't fly in the same plane, just as a risk measure. So let's say there was a shouldn't keep putting these things into the universe. But let's say there was a crash where both you guys happen, and it's like, okay, but the contract said you shouldn't fly together, so you lost the keys, and it's not a qualifying case now. I guess there's also the possibility to like I said in my previous kind of question, like write down some conditions as well as also like payouts criteria.
Yeah, and sorry guys, I did drop out a bit before Australian internet and things, but I just wanted to add one thing which I was thinking about earlier. So because this parametric process is all so efficient, one of the perks obviously for steady state implementing it is we should technically save money, man hours and expenses, and as we don't have to, there's no need for lengthy claim investigations. There's it's faster. It's like the conventional underwriters in the real world for traditional insurance, of course, they take a very long time trying to verify the veracity of a claim or seeing if there's any dodgy activities people are doing. So yeah, like it's this efficient. This process removes the inefficiencies of the legacy insurance protocols and presents this is a great opportunity that we have in DeFi because everything's faster, everything's quicker, we'll save money, and it benefits the user as well. So yeah, just a small perk I thought I should add in, unless Brian and John already did talk about this when I was missing for a couple of minutes.
Yeah, you're right. So that level of capital efficiency is hasn't yet been seen so far in the markets, and we'll be getting there long term as well to be a more efficient system.
That's dope. But let's check out, guys, what our viewers have asked from us as well. So Trading Knowledge asks, what would constitute as a natural disaster in DeFi?
In general, so I think what would constitute as a natural disaster would be, in my opinion, is in any smart contract agreement, a lot of funds going missing and not being accounted for. And that's what you really got to start from natural disaster. And that's the kind of financial, technological emerging risks that we're all really concerned about. And so that's what we're going to constitute as a natural disaster, or such as a lot of money going into a contract that's broken and does not have parameters to stop like money going into the contract. And so that usually though, that second one will be much tougher to insure because you take something like NFTs. If you go into an NFT, enter like deposit, like let's say an Ether sold to get into an NFT, but like all the NFTs are already given away and minted, then it's like you have to rely on the people creating the NFT to pay you back the ETH that, so that will be a lot tougher. But it's really when a lot of money being controlled by a predetermined agreement on a smart contract goes missing or is not accounted for, that's when the arbitration is needing and trying to figure out how it happened or where it went. And that's really where you want to start with natural disasters in DeFi and crypto. And that's the main one. I think another one people think about, especially with layer 2 becoming a big deal, is bridges and breakdown when you're bridging. And I think we all want to get there, but I think the goal is to start with money being accounted for going missing, and then move out to layer 2 solutions and bridging solutions, and where that all works out as well. And we got to think about where the money can go missing or not be accounted for, and all those methods, and how do we track where it goes. The parametric agreement on layer 2s will be significantly harder because there's still a lot of unknown information there, and we have to really work around. But we can also account for other different agreements on that as well.
So just a general question, but for example, if leading off from the example, something what Brian was speaking about earlier, if all the key holders for the treasury are on a plane and the plane crashes, and now the treasury can't be accessed again? Suppose there's six or seven signatories to a treasury, or the DAO treasury for steady state, and we all somehow are on the same flight and the flight crashes. Does that classify as a natural disaster in DeFi, or is that not? Because those funds are locked and lost forever, right? And the protocol might not have a good chance to succeed. Is that not what I don't know. I'm just trying to think what how a
That,
real world.
that would take time to insure, but that should be insured long term. So one of the key problems, and I think we're going to address this in a later question, is that inadvertently, is that we're a small to mid-sized insurance fund. We're going to be building to a large insurance fund. Large insurance funds can cover something like that. There are no large insurance funds in crypto or DeFi right now. And so with something like that, we have to be pretty creative in how we could actually cover that. If you're buying the likeliness of all the Gnosis wallet holders dying, we'd have to really figure out how we can convince people to stake capital on that. Or something, and it may be a fun betting because I'm betting on the death of the community.
If I was to think about it this way, John, like if there was the death of the community or the founding members, I mean, most likely this would result in a price crash, and maybe you have price crash protection into your policy. So potentially it might be covered under some kind of clause which you would have there in Parametric that, okay, the price would crash 80% overnight. This would be an indication of some kind of exploit, therefore payout condition could happen. But yeah, I'm glad I might have found an edge case here, which we can work in future.
Yeah, I mean, that'll take time. Again, we're going to start with the exploits and bugs and start move from there. But yeah, I mean, I think not only that, imagine the memes you're buying, like you can make from doing something like that. Just like you're buying the likeness of someone dying, you're like just like posting that on memes and stuff. That'd be kind of funny. But I mean, there's a lot of opportunities. We just got to start small and build from there. And bugs and black exploits are what we're all scared about. You're not necessarily scared about all your team dying in a plane accident. I don't think. What we're scared about is putting money in curve and making money. That money in curve is gone and due to something out of your control. And so we're going to focus on that. And making sure groups and protocols can say we're insured for that, or protocols who yield aggregators who use other protocols can say we're insured if that happening against that. And you could have a lot more ease when you deposit capital in these funds. And what we want to do long term is make sure everyone can crank the lever up and all the protocols they're using and really help bring DeFi to the next level.
Thanks, guys. Very interesting train of thought. I personally hope everything will be okay with you guys. But Jonathan, you mentioned bridging, and we have a question from Sober Music TLN that is bridging something that could be insured as well.
Yeah, so our clients currently have needs for that. So our goal is to eventually get there. Bridging risk is apparent. I haven't even used Arbitrum yet, sadly. I'm probably going to do that this weekend. But I've watched people use Arbitrum, and there are some serious risks using Arbitrum just on the bridging side of it. And I'm really excited to actually use it this weekend. But I think a lot of seeing kind of the complications there, a lot of V1s and V2s really want that taken care of. So yeah, we're planning to get there. I haven't really thought of an approach yet how we should be considering it though. That's kind of coming at a later date. Probably sometime next year we'll be creating those as well.
Awesome. Thanks, Jonathan. And we have last question from EJ Vanderberg. And he asks, have you guys considered how to tackle potential insurance fraud?
Yeah, so insurance fraud is a very key problem in any small insurance company or mid-sized insurance fund company. The killer in the death is fraud for these guys. Insurance companies creating payouts for fraud. And so what we have currently is we're going to have kind of two methods that are going to evolve as we build this ecosystem. One is we will have some level of arbitration. Contracts, agreements, insurances can be disputed on the parametric level and be reevaluated for bad actor activity. And so if we think the criteria were hit, but the criteria are hit in a way where we think it was kind of planned or self-hacked, then we'll create arbitration for that as well. The other thing it will be doing is controlling which protocols can actually get a policy and which protocols get involved and who we bring on board, and trying to make sure we control that risk as well. What if we can control, the people that can get policies, or control like who can actually get a policy in our ecosystem? Then in theory, we should be able to we control get a policy in our ecosystem, then we can in theory be able to control people who have more to lose than gain from committing kind of bad fraudulent and bad actor activity. And say a lot of these people, if say something, a protocol like let's say Mantra DAO got insurance with us, or DX, they have a lot more to lose than gain from committing fraud. And if people know the people in that team are fraudulent or bad actors, there's a lot of trust issues that naturally derive from that community and something you really control. And we often see that, when you lose trust in your ecosystem leaders, there becomes serious concerns. Blue Kirby was one of them. Remember Yearn took a big hit when Blue Kirby was would turn out he was a bad actor shilling, I think it was NFTs, but Blue Kirby NFTs. But when you perform bad actor activity of any kind of way or seem fraudulent, you really puts a lot of questions in the community, not only yourself, but the community you support. So I think that's kind of our two kind of things we want to control is who comes in, who has more to lose than gain. And secondly, if there's bad activity or sense of that, there is an opportunity to arbitrate that.
Thank you, Jonathan. Well, that's it with the questions. I hope everyone now got the understanding what is parametric insurance, what can be done with it. Many thanks to our speakers, Jonathan, Akash, and Brian. Great discussion we had. And thank you all for tuning in. Before you go, we remind you to take part from Steady State's meme contest. And also, we invite you to take part from our ambassador program. All the information you can find from Telegram or Discord channels. See you all next week. Take care.
Thanks, Libby. Thanks, everyone.
Yeah, bye, guys. Thank you.